Of the Budget Committee to order, and thank our witnesses for being here, and our ranking member, of course. More than a year has passed since our hearing on climate havoc in the insurance industry, upending housing markets, mortgage markets, and local property tax bases, and spilling out into the broader economy. That threat is just one of the systemic risks climate change poses to our economy and to our financial system. Since that hearing a year ago, things have gotten worse in insurance markets, and worse for American families that rely on them. Press reporting, risk assessments, and further warnings are piling up. I'd reference in particular the recent cover article of The Economist magazine. As we heard in those original hearings, you need insurance to get a mortgage. Without a mortgage, most of our constituents could not purchase a home. What happens when insurance companies go bust, or don't renew policies, or pull entirely out of a state? Families lose insurance. They can't find a decent policy. They can't afford what's available. Some even pack up and move away. Some end up with state-backed insurers of last resort, which may or may not be solvent. Some end up with small insurers, which may or may not have the resources to pay claims. This is what we've begun to see in multiple states. One is Florida. 10% of our nation's homeowners live in Florida. Florida homeowners pay on average over $6,000 for insurance, the highest in the country, indeed more than 3 times the national average, which is $1,700. Florida's average premium has doubled between 2020 and 2023, and the trajectory is that it is going to get worse. This has put a strain on many Florida residents. They install hurricane windows and doors to reduce risk, but premiums continue. Are you tracking the charts? Premiums continue their upward march. They put off retirement or skip vacations. For some, such as Deb Wood and her husband, it is simply too much. In Florida, insured losses grew by 206% between 2003 and 2018. 2022 saw Florida residents file over 678,000 personal and commercial insurance claims. Over 40% were hurricane-related. NOAA predicts an 85% chance of an above-normal 2024 hurricane season, with 17 to 25 total named storms and 4 to 7 major hurricanes. In 2022 and 2023, more than a dozen insurance companies left the Florida residential market, including national insurers like Farmers. Residents fled to Citizens Property Insurance, the state-backed insurer of last resort, which ballooned from a 4% market share in 2019 to as much as 17% last year. If it has to pay out claims that exceed its reserves, Citizens can levy a surcharge on Florida insurance policy holders across the state. Good luck with that, particularly if the surcharge grows to hundreds or even thousands of dollars. To depopulate its books, Citizens has let private insurers cherry pick out its least risk policies. Those private insurers may have problems of their own, as we will hear today. This all looks like an insurance market that is swirling the drain. As one of our witnesses put it, and I quote, "Unreliable insurance could result in a situation where large climate shocks may cause property damage at the exact time that the property insurer becomes insolvent, increasing household default incentives and losses given default." End quote. What will the collision of increasingly unreliable insurance and greater mortgage defaults mean? Who will be left holding the bag? The federal budget takes a hit because these insurers and their policies are accepted by Freddie Mac and Fannie Mae, who either own or guarantee a large part of our $12 trillion mortgage market. This all sounds eerily reminiscent of the run-up to the mortgage meltdown of 2008, including a role of potentially captive or not fully responsible rating agencies. Florida is far from alone. A New York Times investigation found that the insurance industry lost money on homeowners coverage in 18 states last year. And the states may surprise you. The list includes Illinois, Michigan, Utah, Washington, and Iowa. Insurers in Iowa lost money each of the last 4 years. This is a signal that hurricanes and earthquakes, once the most prevalent perils, are being rivaled by hail, windstorms, and wildfires. Last year, the U.S. experienced 28 separate billion-dollar extreme weather events. Over the past decade, 28 states have been hit by such events more than twice in a year. I should say twice or more in a year. 38 states were hit in back-to-back years, and losses are expected to climb. So too will premiums, that is, where insurers are even willing to stay. In one example, the premium on a $250,000 home for a 40-year-old couple with a combined good credit rating and clean claims history would increase by as much as 63% in Louisiana and 61% in Nebraska. To borrow from the Times article, quote, "The question facing insurance companies around the country and the homeowners who rely on them is which state might be heading in the same direction as Florida. The answer from our reporting, it could be any of them." End quote. Or as a former state insurance commissioner said, "We're marching toward an uninsurable future." This isn't all that complicated. Climate risk makes things uninsurable. No insurance makes things unmortgageable. No mortgages crashes the property markets. Crashed property markets trash the economy. It all begins with climate risk, and a major party pretending that climate risk isn't real imperils our federal budget and millions of Americans all across the country. I'll just add in closing that the scale of the exposure that we're talking about today and the paucity of our response and the numerosity and severity of the warnings we have heard from responsible people, and the role of underinsurance and potentially unreliable ratings from rating agencies is really ringing a lot of alarm bells with me of what we looked like going into 2008. With that, I'll turn to my distinguished ranking member, Senator Grassley.
Thank you, Mr. Chairman. Welcome to our panel of experts. If the federal government is going to remain ready to respond to the natural disasters and national emergencies, we have to have the capability of doing that, and it seems to me that begs to put the nation's fiscal house in order. Yet, even with interest on our national debt, and that is set to surpass defense spending this year, the majority refuses to write a budget or work together to curb reckless Washington spending. This week is more of the same with our 19th hearing on climate change. President Biden and the majority would like us all to ignore our exploding $34 trillion debt. The majority hopes that we stop discussing how unchecked deficit spending has fueled inflation, hammering hardworking Americans, and I will say shortly, has something to do with driving up the cost of insurance. Families now face prices that are 20% higher than when President Biden took office. 65% of Americans report that entrenched inflation has made the financial situation worse off under the Biden administration, and that's not Chuck Grassley, that's according to the Federal Reserve. Moreover, recent high interest rates have contributed to Americans struggling to pay record high credit. That means their credit card bills or afford a home mortgage. As Federal Reserve Chairman Powell has said, quote, "It's probably time or past time to get back to an adult conversation about elected officials." I missed something. Among elected officials, about getting the federal government back on a sustainable fiscal path, end of quote. Absent corrective action, Iowans, and for that matter, all Americans, will be faced with even higher interest rates, lower incomes, and elevated inflation, and that'll be the situation for years to come. As to the subject of today's hearing, we've seen this show before. The majority continues to crusade against American fossil fuel companies. They want to bully insurers into abandoning their diversified portfolios so they stop underwriting all fossil fuel projects. If the majority get their way, Americans can expect to pay much more to put gas in their cars and to heat their homes. Now, I've done battle with big oil in the past, particularly when it comes to their opposition to biofuels. And I support reasoned oversight over insurance companies. But oversight isn't the same thing as advocacy that seeks to punish those that hold different views from one's own. As Justice Sotomayor wrote in last week's unanimous NRA versus Volo decision, quote, "Government officials cannot attempt to coerce private parties in order to punish or suppress views that the government disfavors," end of quote. Insurance premiums are far too high across the board and may increase after the recent storms, including those very storms in my state of Iowa. Climate change isn't the primary driver of insurance rates hikes, and collapse of the insurance industry isn't imminent, although I'll have to say Iowa had 6 property and casualty companies pull out of insuring Iowans. Climate change doesn't explain why auto insurance premiums in 2024 have increased by a whopping 20% year over year. It also doesn't account for the consistent failure of liberal cities to fight crime, which has raised insurance risk and even caused insurers to deny coverage. Expensive liberal policies, not climate change, are much to blame for these market dynamics. Insurance companies and reinsurers are scrambling to wrangle inflation like the rest of us. Disasters cost more than ever because the goods and services are much more expensive. Moreover, there are more rich people living in areas affected by weather, all the way from Newport down to Miami Beach. It's simply more costly to pay the bill for insurance claims. What's more, the Federal Reserve can't keep up with the Biden inflation despite hiking interest rates to a 23-year high. Reinsurance companies are in the business of purchasing risks from insurance company portfolios. It's only rational for them to forego risky investments when the U.S. Treasuries pay such a healthy return. Inflation has become embedded in the economy, and historic levels of borrowing by the federal government are crowding out the private sector. It only makes sense that the majority would rather point the finger at climate change. To do otherwise means that they acknowledge their reckless spending is a major cause of the problem. So I welcome all today's witnesses, and I look forward to each of your testimonies and hope you guide this committee to focus on our primary responsibility. Thank you.
Thanks very much, Senator Grassley. Before I introduce the witnesses, let me just point out that we have a budget agreed to in bicameral and bipartisan fashion. And with respect to reducing fiscal risk, I've been pursuing that on 4 routes. One is de-risking the budget, which is important because a third of our national debt came from shocks, economic shocks, that we could have predicted, that were not part of regular and ordinary budgeting. Second, raising revenues, particularly on the corporate sector, whose contribution to our government revenues has declined dramatically across recent decades. And of course, high-end people, including billionaires who literally pay 0 in income tax. Third is to reduce healthcare spending. It's a major component of our spending, and with system reforms that the ranking member and I have discussed, and a number of bipartisan bills we're working on, I think we can make real progress there. And the last, and probably the least, is to review appropriated spending. That is not the highest value or the most significant important focus, I think, in terms of getting to a balanced budget, but it is a small part of the overall equation.
Could I respond to that before you introduce our people? Yeah. We don't have a budget resolution for 2025. What we do have is called a deemer, and it's no substitute for a real congressional budget resolution that can be debated and amended on the floor by all 100 senators. A deemer has none of the basic contents of a congressional budget required under Section 101 of the Budget Act. And while a budget resolution can offer a serious financial plan for the federal government, deemers based on baseline estimates are simply placeholders until we finish a real budget. Last year's debt limit deal explicitly said that a deemer does not prevent Congress from doing a real budget resolution for 2025. Thank you very much.
That is true, and it remains the case that we have a budget that was agreed to in bicameral and bipartisan fashion. The first witness is Raid Masullin. Raid is an actuary with 45 years of experience in insurance, specializing in property pricing, natural perils, reinsurance, agriculture, catastrophe risk modeling, public policy development, and climate risk. Specifically, he spent many years working in Florida, including as chair of the Florida Hurricane Catastrophe Fund Advisory Council during the time in which Citizens Property Insurance Corporation was established. Our second witness is Dr. Ishita Sen. Dr. Sen is an assistant professor at Harvard Business School. Her recent research examines the pricing of property insurance and the interactions between insurance and mortgage markets. This includes the role that institutions and the regulatory landscape play and the broader consequences for real estate markets, climate adaptation, and our overall financial stability. Our third witness is Deb Wood. Ms. Wood and her husband, Dan McGrath, are both retired Floridians. They moved to South Florida in 1979 and lived in Broward County, which includes Fort Lauderdale, for 43 years, until skyrocketing insurance premiums became too much. They now reside in Tallahassee, Florida. I will now turn to my ranking member, Senator Grassley, to introduce the Republican witnesses.
Thank you for the privilege of introducing my invitees to this committee. Dr. E.J. Antoni is a research fellow at the Heritage Foundation Grover M. Herman Center for Federal Budget. His research focuses on fiscal and monetary policy, and he previously was an economist at the Texas Public Policy Foundation. Antoni earned his master's degree and doctor's degree in economics from Northern Illinois University. Commissioner Glenn Mulready has served as Oklahoma's 13th insurance commissioner and was first elected to this position in 2019. Commissioner Mulready started his insurance career as a broker in 1984 and also served in the Oklahoma State House of Representatives. He supports efforts to continue to apply best practices, modernizing the Oklahoma Insurance Department, and embracing new technology to serve the people of Oklahoma. Welcome to both of you.
With that, Mr. Masullin, you have 5 minutes, and your entire written testimony, which was very helpful and I appreciate, will be made a part of the record of the proceedings. Please proceed with your oral statement.
Well, Chairman Whitehouse, Ranking Member Grassley, and distinguished members of the committee, thank you for the opportunity to appear before you today. My name is Ray Muslin. I'm an actuary who has extensive experience in natural hazard risks and funding arrangements for the damage and loss they cause. I've worked with many public sector entities on policy responses to the challenges of affordability, availability of insurance, and community resilience. This work included participating in Florida's response to Hurricane Andrew, which included the creation of the Florida Hurricane Catastrophe Fund and Citizens Property Insurance Corporation. The CAT Fund and Citizens can access different forms of funding than traditional insurance companies. Instead of holding sufficient capital or reinsurance before an event to cover the cost of potential losses, both entities use public sources of capital to reduce upfront costs by partially funding losses post-event through bonding and assessments. All property casualty insurance policyholders, whether in Citizens or not, are subject to its assessments, while the CAT Fund can also assess almost all policies, including automobile. This approach exposes Floridians to debt and repayment if large losses occur, and it subsidizes high-risk policies from the entire population. These pools, others like them in other states, and the NFIP have contributed to rapid development in high-risk areas, driving higher costs in the long run. In Florida, national insurers have reduced their exposure, as a significant proportion of the insurance market has moved to Citizens or smaller insurers with limited capital that are heavily dependent on external reinsurance. Now, to date, Florida's system has been successful in meeting its claims obligations, while improvements in building codes have reduced loss exposure. However, For a variety of reasons, including exposure to hurricanes, claims cost inflation, and litigation, Florida's insurance premiums are the highest in the nation, causing significant affordability stress for consumers. According to market research from Bankrate, the average premium for a $300,000 home in Florida is 3 times the national average, with some areas 5 times the national average. A major hurricane hitting a densely populated area like Miami could trigger large and long-lasting post-event assessments, or even exceed the system's funding capacity. Continued rapid exposure growth and more extreme hurricane losses amplified by climate change will cause increasing stress on the nation's insurance system, which may be felt through solvency issues, non-renewals, growth of government pools, and affordability pressure. Evidence of increasing risk abounds, including Hurricane Otis in 2023, which rapidly intensified from a tropical storm to a Cat 5 hurricane and devastated Acapulco in Mexico. Last summer, water temperatures off Florida exceeded 100 degrees Fahrenheit. Last week, as was alluded to earlier, NOAA forecast an extremely active hurricane season for '24. We've seen losses in the mid-Atlantic from Sandy, record flooding from Harvey, and extreme devastation from Maria, among others. In coming decades, we must prepare for the possibility of more extreme hurricanes and coastal flooding from Texas to New England. Florida's experience is a warning of what we may see in the future in other states. Despite its innovative and extensive efforts to address its hurricane problem, premiums are high, consumers may face large assessments, and many are dependent on citizens and smaller insurers. Most current building codes and land use policies in the country do not reflect potential future risk. Even if we undertook rapid action to address this, existing exposure and likely development will leave us vulnerable to large losses for decades to come, which may trigger more widespread availability and affordability issues or even calls for federal assistance. The combination of demographics, development, and disasters pose a significant risk to our financial system, and climate change increases that risk. Addressing this will be a long-term effort which involves very difficult public policy choices. Thank you.
Thanks very much. Dr. Sen, please proceed with your testimony.
Good morning, Senators. I am Ishita Sen, Assistant Professor at Harvard Business School, and my research studies insurance markets. In recent work with co-authors at Columbia University and the Federal Reserve Board, I examine how climate risk creates fiscal and potentially financial instability because of miscalibrated insurer screening standards and repercussions to mortgage markets. Insurance is critical to the housing market. Property insurers help households rebuild after disasters by preserving collateral values and reducing the likelihood that a borrower defaults. Insurance directly reduces the risks for mortgage lenders and the government-sponsored enterprises such as Fannie Mae and Freddie Mac. Mortgage lenders therefore require property insurance, and the GSEs only purchase mortgages backed by insurers who meet minimum financial strength ratings, which measure insurers' solvency and ability to pay claims. The GSEs accept 3 main rating agencies: AM Best, S&P, and more recently, Demotech. And to provide an example, Fannie Mae requires insurers to have at least a B rating from AM Best or at least an A rating from Demotech to accept a mortgage. Now, despite having this policy in place, we find a dramatic rise in mortgages backed by fragile insurers and show that the GSEs, and therefore the taxpayers, ultimately shoulder a large part of the financial burden. Our research focuses on Florida because of availability of granular insurance market data, and we show that traditional insurers are exiting, and the gap is rapidly being filled by insurers rated by Demotech, which has about 60% market share in Florida today. These insurers are low quality across a range of different financial and operational metrics and are at a very high risk of becoming insolvent. But despite their risk, these insurers secure high enough ratings to meet the minimum rating requirements set by the GSEs. Our analysis shows that many actually would not be eligible under the methodologies of other rating agencies, implying that in many cases these ratings are inflated and that the GSE's insurer requirements are miscalibrated. We next look at how fragile insurers create mortgage market risks. So in the aftermath of Hurricane Irma, homeowners with a policy from one of the insolvent Demotech insurers were significantly more likely to default on their mortgage relative to similar borrowers with policies from stable insurers. This is because insurers that are in financial trouble typically are slower to pay claims or may not pay the full amounts. But this implies severe economic hardships for many, many Floridians, despite having expensive insurance coverage in place. However, the pain doesn't just stop there. The financial costs of fragile insurers go well beyond the borders of Florida, because lenders often sell mortgages, for example, to the GSEs, and therefore the risks created by fragile insurers spread from one state to the rest of the financial system through the actions of lenders and rating agencies. In fact, we showed two reasons why the GSEs bear a large share of insurance fragility risk. First is that lenders strategically securitize mortgages, offloading loans backed by Demotech insurers to the GSEs in order to limit their counterparty risk exposures. And second, that lenders do not consider insurer risk during mortgage origination for loans that they can sell to the GSEs, even though they do so for loans that they end up retaining, indicating lax insurer screening standards for loans that can be offloaded to the GSEs. Before I end, I want to leave you with two numbers. Over 90%, that's our estimate of Demotech's market share among loans that are sold to the GSEs. And 25 times more, that's Demotech's insolvency rate relative to AM Best among the GSE-eligible insurers. Projections suggest risks will continue to grow with climate change and more building in risky areas. That is, unless action is taken to correct incentives and strengthen insurance markets, which include properly accounting for insurer solvency risks and climate risks. A necessary starting point for all of this is access to granular insurance underwriting data. I urge regulators to collect these data in a comprehensive way and make it widely available for research. I really appreciate this opportunity, Senators, and your timely efforts on this issue. Thank you.
Thank you very much. I now have the pleasure of welcoming Ms. Deborah Wood, who can bring some lived experience to the expert testimony that we have heard. Please proceed, Ms. Wood.
Good morning, and thank you for inviting me. My name is Deborah Wood. My husband, Dan McGrath, and I moved from New Jersey to South Florida in 1979. We lived in Broward County for 43 years until we sold our home in January 2023, in part because our home insurance was becoming unaffordable. My husband and I are retired. He was a public school teacher of special needs children, and I was a journalist. Dan and I raised our two daughters in Florida, and all four of us have earned degrees from Florida public universities. In 1994, we moved to the city of Plantation, about 10 miles inland from the East Coast. Home insurance rates were reasonable in those early years, and when we had to replace our roof in 2008 after a storm, the claims process was very smooth. Our policy renewed each October with manageable rate increases. That changed in recent years. In 2017, we paid $3,700 per year for insurance, and in subsequent years, the rates increased significantly so that our proposed renewal for 2023 was more than $8,000. Our problems with insurance began in 2017. Sometime before my husband and I left on a trip, a man showed up unannounced saying he was from my insurance company and wanted to take a look at the property. As he had no identification, I declined him access. I left the company a voicemail and forgot about it until a few weeks later when I received a notice that our policy would not be renewed because I had refused an inspection. I contacted them immediately, said there was a misunderstanding, and asked them to send another inspector. They did. I didn't hear anything more and naively thought We no longer had a problem. I was wrong. In early September, my husband and I were at the Grand Canyon National Park when we caught the news of Hurricane Irma's pending assault on Florida. I knew we'd be covered for the storm, but I wanted reassurance that my policy was on track to be renewed in October, so I called the company. I will never forget that phone conversation. I was told that we still would not be renewed, but now the reason was because my roof had failed inspection. I asked, why did you not tell me this? And the answer was, because we don't have to. I asked for the roofing report and was told, no, that was the property of the insurance company. So this company that I had done business with for at least 20 years was not only dropping us, but was allowing us to ride out a potentially catastrophic storm with what they had determined was a detective roof without even warning us. Fortunately, we only incurred minor damage from Irma, but we had to scramble to find a new company in a matter of weeks in a state that had sustained major damage. Our roof passed the new company's inspection with no problems, even after Irma. But unfortunately, their rates were higher and kept increasing even as we had no new claims, reduced our coverage, replaced our windows and doors with hurricane-proof glass at a cost to us of about $40,000. My husband and I never intended to move. We loved our community, our neighbors, and our friends. Our home in South Florida was the regular gathering place for extended family. We truly enjoyed hosting visitors. But in 2022, we began discussions as to whether South Florida was still the best place for us. There were family concerns, the weather events were becoming more and more frequent, and maintaining our home was becoming expensive. The insurance quote for 2023 gave us the push to put the house on the market. We intended to buy another home in Tallahassee, Florida, near our daughter and son-in-law. We put our belongings in storage, moved in with them, and looked for a new home. Flash forward to 2024, we have reluctantly made the decision that we will not be buying a home in Florida. We've learned there's no escaping the insurance problems, and weather disasters are becoming more and more prevalent, even in previously safe areas like Tallahassee. We haven't decided what our next step will be, but at this stage of our lives, we are not willing to risk our financial well-being by buying a home that one day may be uninsurable or craters in value in a housing market fueled by the homeowners insurance crisis.
Thanks very much. Our next witness may proceed.
Chairman Whitehouse, Ranking Member Grassley, members of the committee, thank you for the opportunity to address you today on a topic that's becoming increasingly important to homeowners across the nation, increasing homeowners insurance premiums. As natural disasters continue to rise, understanding the dynamics of insurance pricing is crucial for both homeowners and policymakers. Homeowners insurance is a fundamental safeguard for what is for many Americans their single largest asset. This important coverage protects against financial loss due to damage or destruction of a home and its contents. However, recent years have seen a notable increase in insurance premiums. One significant driver of this rise is convective storms and other severe weather events. Convective storms, which include phenomena like thunderstorms, tornadoes, and hail, have caused substantial damage in various regions. The cost to repair homes and replace belongings after such events has skyrocketed, leading insurance companies to adjust their premiums to cover that increased risk. Beyond convective storms, we've witnessed hurricanes, wildfires, and flooding. These events have not only caused damage, but have also increased the long-term risk profile of many areas. Insurance companies are tasked with managing that risk and have responded by raising premiums to ensure they can cover those potential claims. Another major factor influencing homeowners insurance premiums is inflation. Inflation affects the cost of building materials, labor, and other expenses related to home repair and reconstruction. As the cost of living increases, so does the cost of claims for insurers. When the price of lumber, steel, and other essential materials goes up, the expense of repairing or rebuilding homes also rises. Insurance companies must reflect these higher costs in their premiums to maintain financial stability and ensure they can meet those contractual obligations to policyholders. So what can homeowners do to mitigate these rising costs? One of the most effective strategies is proactive mitigation. Homeowners can invest in measures that reduce the risk of damage from severe weather events. For instance, installing storm shutters, reinforcing roofs, using, quote, hail-resistant shingles, and using fire-resistant materials can make a home much more resilient. Additionally, maintaining proper drainage systems and removing potential fire hazards from around the property can help. Insurance companies often provide discounts for homes that incorporate these protective measures, making them a worthwhile investment for homeowners. I believe the most essential aspect of managing insurance premiums is fostering a robust, competitive free market. Competition among insurance companies encourages innovation and efficiency, leading to better pricing and services for consumers. When insurers can properly underwrite and price for risk, they create a more balanced and fair market. This involves using advanced data analytics and modeling techniques to accurately assess the risk levels of different properties. By doing so, insurance companies can offer premiums that reflect the true risk, avoiding excessive charges for low-risk homeowners and ensuring high-risk properties are adequately covered. Regulation also plays a crucial role in maintaining a healthy insurance market. Policyholders must strike a balance between consumer protection and allowing insurers the freedom and flexibility to adjust their pricing based on the risk. Overly stringent regulations can stifle competition and lead to market exits, reducing choices for consumers. We've seen this play out most recently in another state, where there were artificial caps put in place on premium increases. That worked well for consumers in the short term, but then one by one, all of the major insurers began announcing they would cease to write any new homeowners insurance in that state. These are all private companies, and if there's not the freedom and flexibility to price their products properly, they may have to take drastic steps, as we've seen. Conversely, a well-regulated market encourages transparency and fairness, ensuring that homeowners have access to the most affordable and adequate coverage options. In conclusion, the rise in homeowners insurance premium is driven by severe weather events and the impact of inflation. However, homeowners are not powerless in the face of these challenges. By investing in mitigation measures and supporting a competitive insurance market, they can manage costs and ensure their homes are protected. Collaboration between homeowners, insurers, and policymakers is essential to create a sustainable and resilient insurance landscape. Thank you for your attention. I look forward to any questions you might have.
Thank you very much, sir. Appreciate you being here. Dr. Antoni.
Chairman Whitehouse, Ranking Member Grassley, members of the committee, thank you for the invitation to discuss with you today the current state of the insurance and reinsurance markets, and especially how they have been impacted by inflation and climate change. I'm a public finance economist and the Richard F. Astor Fellow at the Heritage Foundation, where I research fiscal and monetary policy with a particular focus on the Federal Reserve. I am also a senior fellow at the Committee to Unleash Prosperity. Since January 2021, prices have risen a cumulative 19.3% on average in the American economy. Construction prices for single-family homes have risen much faster, up 30.5% during the same time. This has been a direct result of public policy choices made here in Washington, D.C., and those choices have imposed significant costs on the insurance industry. Unprecedentedly large federal deficits over the last 4 years, financed by the Federal Reserve's purchase of Treasury securities, increased the money supply by trillions of dollars, much faster than the increase in the real economy. Roughly 1/3 of all dollars in existence were created in just a few years. That transferred wealth from the people to the government and devalued the dollar at rates not seen in 4 decades. Consequently, it now takes more dollars to purchase the same products and services. This has increased repair and replacement costs throughout the economy, which has directly contributed to higher insurance premiums and losses for insurers and reinsurers alike. Actuarial tables used in underwriting to estimate risk and future losses, as well as calculate premiums, rely heavily on those input costs. When prices increase radically, precisely as has happened over the last several years, old actuarial tables are of significantly less use when pricing premiums because they will grossly understate the future cost to the insurer. The sharp increase in total claim costs since 2019 has resulted in billions of dollars of losses for both insurers and reinsurers, prompting large premium increases to stop those losses. This has put significant financial stress on consumers who are already struggling with a cost of living crisis and are now faced with much higher insurance premiums, especially for homeowners insurance. Other factors, mostly stemming from public policy failures, have contributed to today's insurance premiums as well. The widespread rioting caused by groups like BLM and Antifa in 2020 caused $100 billion in damages, a massive financial loss for the insurance industry. Likewise, general lawlessness in American cities over the last several years and the refusal of government authorities to protect private property has resulted in more damages, more claims, and ultimately higher premiums. Overregulation has also put upward pressure on premiums by increasing repair and replacement costs, a fact which is frequently omitted from the cost-benefit analysis conducted when such regulations are proposed. Lastly, while some assert that climate change has been a significant contributor to higher premiums and general stress in the insurance industry, there is no empirical evidence to support this claim. In fact, the evidence indicates it is not true. For example, hurricanes are not becoming significantly more numerous nor more powerful, but we are building more homes in their path, and we are building more expensive homes there too. The increase in claims related to weather events has undoubtedly increased, but it is not due to the climate changing. This is why the insurance and reinsurance markets do not rely heavily on climate modeling when pricing premiums. Furthermore, climate models are inherently subjective, not merely in how the models are constructed, but also by way of the inputs that the modeler uses. In other words, because insufficient data exists to create a predictive model, a human being must make wide-ranging assumptions and add those to the model in place of real-world data. Thus, those models have no predictive value for insurers. If government broadly, and this committee specifically, seek to relieve stress to the insurance industry and lower costs to consumers, your focus should be on reducing the government spending that created the inflation, which is responsible for most of the increase in insurance premiums over the last several years. Passing a budget, ideally a balanced one, would be a good place to start. Thank you kindly for your time, and I look forward to your questions.
Thank you. Mr. Masullin, your testimony is that a major hurricane hitting a densely populated area like Miami could trigger large and long-lasting post-event assessments or even exceed the system's funding capacity. What does exceeding the system's funding capacity look like?
Well,
Your microphone, please.
Oh, it's on, sir. Sorry. According to public statements, the system can currently cover events like in Citizens up to their modeled 100-year event. But also note that the ability of Citizens to pay claims depends on the ability of the CAT fund to pay its reinsurance obligations. There are certainly storm scenarios, such as a repeat of the 1926 Great Miami Hurricane, which have been estimated to cost well over $125 billion to the market. And there is a point at which an event becomes large enough to exhaust Florida's entity's ability to issue bonds and collect assessments.
And then what happens?
Well, and then Florida will face some very difficult choices, which could include raising assessment caps or finding some other source of funding or taking other actions to try to
You kind of step
meet
into the
obligations.
unknown at that point, right?
Yes, sir. I will note that that's an extreme event, but
Yeah.
it is something that has happened in the past.
You say that this combination of demographics, development, and disasters poses a significant risk to our financial system. What do you mean by risk to our financial system?
Well, Senator, if you look at the combination, as has been pointed out, of high growth and wealth accumulation in coastal areas, and you look at just what we've observed in the climate, much less what's predicted in the future, there is significant exposure along the coastline from Maine to Texas. In fact, my family's from New Jersey, and there is enormous development on the coast of New Jersey. And if we start to get major hurricanes coming through those areas, the building codes are probably not up to the same standards they are in Florida, and we could be seeing some significant losses, as I believe was pointed out in a recent
And how does
Federal
that
Reserve
create
study.
risk to the financial system?
Well, because it's sort of a set of dominoes. You start with potentially claims issues with the insurers, being stressed and not ability to pay claims. You have post-event rate increases, as we've seen in Florida. You could have situations where people cannot secure insurance because they can't afford it, then that affects their mortgage security and so on and so forth. So there are a number of ways that this could affect the financial system, sir.
Cascading beyond the immediate insureds and becoming a national problem.
Well, I would just note, Senator, that in Florida, the real problem started years after we got past Andrew. You know, we got past paying the claims in Andrew, and then the big problems occurred later when we tried to renew the policies.
Do you have your testimony in front of you?
Yes, sir.
Could you turn to page 9 where you have a graph?
Okay, just a second, please. I may need my glasses for this, Senator, excuse me. Age-related issue. Yes, sir.
On page 9, you have a graph of the Florida Hurricane Catastrophe Fund, and there's a bottom line that says total liquidity resources below potential obligations, and then there's a number. Could you explain that line?
Yes, well, basically, that represents the amount of debt, which in this case, almost $7 billion, that they would have to issue in order to meet their claim obligations, because that is not money that they have on hand from their fund balances, pre-event bonding, et cetera.
Thank you. Ms. Sen, your testimony basically describes the Florida risk being transferred to the federal government through Demotech Insurance, that taxpayers bear large unpriced exposure to climate risk through insurance market fragility, and that fragile insurers with inflated ratings now dominate insurance markets in Florida. Is that correct?
That's right.
And you see in this, and I'm quoting you here, parallels in the 2008 financial crisis. What parallels do you see?
So just like what happened during the financial crisis, there were rating agencies that gave out high ratings to pools of mortgages backed by subprime loans. Here we have a situation where rating agencies like Demotech are giving out inflated ratings to insurance companies. The end result is sort of same. There is just too much risk and too many risky mortgages being originated, in this case, backed by really low-quality insurers that are then entering the financial system. And the consequences of that has to be borne by, of course, the homeowners, but also the mortgage owners, GSEs, the lenders, and ultimately the federal and state governments.
You say, this will be my last question, the fragility of property insurers is an important channel through which climate risk might threaten the stability of mortgage markets and possibly the financial system. What do you mean when you refer to a risk to the financial system?
Well, as I was explaining, the GSEs, if there are large losses that the GSEs face, then those losses have to be plugged by somebody, so the taxpayers. That's one channel through which you've got risk to the financial system. And the GSEs serve as a backstop in the mortgage market. They may not have the ability or capacity to do so in such a scenario, which affects mortgage-backed security prices, which are held by all sorts of financial institutions. So that starts affecting all of these institutions. On the other hand, if you've got a bunch of insurers failing, another channel is these insurers are one of the largest investors in many asset classes like corporate bonds, equities, and so on, and they may have to dump these securities at inopportune times, and that affects the prices of these securities as well.
Senator Grassley.
Thank you, Mr. Chairman. Dr. Antoni, is there any evidence to support the notion that climate change is the greatest threat to the insurance market?
No, Senator, there is not. And part of that has to do, again, with the fact that when we look at the models that are used to predict climate change, we simply don't have enough empirical data with which we can input into those models. And so as a result of that, we have to have human assumptions on what we think is going to happen based essentially on a guess. And as a result of that, these models really are not of any predictive value. And that's why these models for the last 50 years have been predicting catastrophic outcomes, none of which have come true.
Okay, and also to you, Dr. Antoni, how has the Biden administration's economic leadership failed to help our economy, and what can this committee do to get our economy back on track?
Senator, I would say the biggest failure in terms of the Biden administration on economic policy has been constantly pushing for more and more spending, which this government and the American people simply cannot afford. And as a result of that, we have today's not only inflation problem, but today's cost of living crisis as well. And the increase in insurance premiums is part of that. In terms of what this committee and the Congress more broadly can do, they need to be, in my opinion, sending the White House balanced budgets, regardless of how large of a budget the White House is asking for.
And Commissioner Mulready, you heard me say that we had 6 property and casualty companies pull out of Iowa. So from your experience, what can states do to increase market competition and best serve policyholders?
Thank you, Mr. Ranking Member. If I can, I'd like to address something before that, just quickly. This focus on the rating agencies. I would agree with that if that were sort of the be-all, end-all, but the state insurance commissioners in each 50 states is tasked with the financial solvency of the insurance companies. We do not depend on rating agencies for that. We are doing financial exams on them. We are doing financial analysis every quarter on each one of them. So I would agree if that was the sort of be-all, end-all, forgive that phrase, but it's not at all, and we don't depend very much at all on those rating agencies from our standpoint. Okay, that said, to your question, what can we do? In my comments, I mentioned I think the most important factor is having a robust, competitive free market. In the state of Oklahoma, we have over 100 companies licensed to write homeowners insurance in our state. We had one company leave. You mentioned, I think, that you had a handful. We had one who exited 9 different states because it was a very, very small piece of their business. But I think having a business-friendly environment and allowing folks to come in and offer their products and offer consumers choices is the most best thing that you can do. I think, secondly, I can't focus enough on mitigation and resilience. The state of Oklahoma just passed 2 weeks ago, the governor signed a bill that we pushed through to strengthen Oklahoma Homes Act. The governor signed that into place. It will allow us to issue grants to Oklahomans as they're replacing their roofs or they want to replace their roofs, to upgrade to more resilient shingles, fasteners, windproofing, that sort of thing. So homes in Oklahoma can withstand, up to 130-mile-an-hour winds. So there is mitigation. There are things that can be done. I think that as policymakers and as a former policymaker, the things we can do is help incentivize that. I know that the Senate has before them, I think it's Senate Bill 1953. Very easy thing. Should be a no-brainer. It's the Tax Parity Act for disaster mitigation that will just allow state-based programs like ours that other states are doing. Kentucky passed that this legislative session as well. It will address the tax issue for those folks that receive those grants.
Commissioner, this is my last question. How have you worked with both political parties to reduce costs, remove red tape, and create a stronger economic environment for Oklahomans?
Well, I blew it with a lot of that in that last answer. I would just respond with that we have worked with that piece of legislation that passed. I will tell you that the National Council of Insurance Legislators, NCOIL, if you didn't know, there's an association of state legislators who focus on insurance issues. The chairman of that Property and Casualty Committee is a Democrat from Oklahoma who has pushed through, is leading the way to make that a model act across the country. And so there's a bipartisan effort there. I'll just tell you that when I was in the House, I worked on a substantial number of issues with the Senate Minority Leader, who was a Democrat attorney from Harvard, actually. And we did a lot of good work on the insurance side of things. Insurance isn't a partisan issue. Mitigation and resilience is not a partisan issue.
For the majority, I'm done.
Thank you, Ranking Member Grassley. I'm going to take over the helm, but lest my head swell too big, I'm not going to take the chairman's seat. I'm going to do it from here. And I'm up next. Ms. Wood, I wanted to dig into your question. I really appreciate you being here and sharing your story. And tell me a little bit more. You thought moving to Tallahassee, farther away from the coast, where maybe the weather emergencies were less extreme, you thought that would be the solution, and yet why was that not the solution? You had a bad experience with this insurer that was going to cut you off without even telling you and not even sharing the information about your roof. You did find another insurer, but were there not companies in the Tallahassee area when you talked to them that would offer affordable homeowners insurance? And is that part of the reason why you've decided not to buy another home in Florida?
Thank you. When we knew that South Florida was kind of the epicenter of the weather disasters, the insurance problem, and we thought Tallahassee would be safer. Our daughter lives there. And we started looking for homes, and we started talking to people about their insurance problems, and they were basically repeating the same things that were happening down south at a lower level. We just, a few weeks ago in Tallahassee, had a freak thunderstorm come through, knock out the power to 70,000, 80,000 people for several days. And it wasn't a hurricane. It was a storm, a rainstorm. And then I started talking to people, how are you doing? What do you see here? And they all say they are seeing increased weather events where they live, where they didn't have that before.
One of the things about your testimony that's important is, I'm a senior citizen now. You are too. You and your husband, you described the ability of seniors to just kind of tolerate an unknown upside increase in a big cost item like insurance is pretty darn limited. And so when you are worried about the unpredictability of upside, that hits seniors particularly hard. Dr. Sen, I have a question for you. When we talk about the impact of insurance on housing, we're often thinking about homeowners, but there's a significant impact to multifamily properties as well. I reached out to the Virginia Housing Agency, which is our housing financing agency that largely supports low and moderate income rental properties. And I asked about what they're seeing on projects that their agency finances. Across the 119 local jurisdictions on which they have sufficient data, 105 are averaging at least double-digit annual increases between 21 and 23, and 9 average triple-digit increases, including 2 in the Hampton Roads area near the Atlantic Ocean, Virginia Beach, and Chesapeake. If you're a nonprofit developer or public housing agency serving low and moderate income families, and it's an important thing, these increases are really tough on the developer, and then they get passed on to a tenant, unlimited means. Are the same dynamics in play when we talk about multifamily insurance markets as in single family?
Yeah, so in Florida, similar set of insurers are sort of in both markets. And so I would expect similar dynamics play out. However, unfortunately, we haven't been able to explore this in as much depth, in part because the data on multifamily insurance is not granular enough for us to look at it in any sort of systematic way. And that's why collecting these data, the FIO NAIC call, needs to focus across all segments of insurance and collect these data in a systematic way so that we can look at them, because these issues are so much worse for people with low income. In the low-income segment, their premiums are the highest, and they've also sort of grown the most in the past few years. If I could also respond to Mr. Mulready on the point about regulators sort of looking at, and we shouldn't pay, rating agencies is not something that we need to look at. I would just point out that in Florida, if you look at the number of exams that the Demotech-rated insurers, that, by the way, have a 20% insolvency rate relative to 0% for traditional insurers, they get examined at the same rate as the traditional insurers like Farmers and Allstates get examined, which is not something that you would expect. If you're more risky, you would expect regulators to come look at them much, much more frequently. And the risk-based capital requirements that we have currently, which were designed in 1980s, they are just not sensitive enough to new risks like wildfire and hurricanes and so on, and also not as well designed for under-diversified insurance companies, because if so, all of these insurers were meeting the risk-based capital requirements. However, at the same time going insolvent at the rate of 20%. So those two things sort of don't really go hand in hand.
Thank you. Senator Johnson.
Thank you, Mr. Part-time Chair, but now we got the real guy back. So first of all, I think the premise of this hearing is just completely off. And I think the chart that the chairman talked to you about, Mr. Muslin, is indicative of that. So the Florida Hurricane Catastrophic Fund, or Catastrophe Fund, has a shortfall for a year about $7 billion, right? Okay.
Yes, sir. And-
So we've had testimony before this committee that we've already spent $5 to $6 trillion. That's 5,000 to 6,000 billion dollars trying to mitigate climate change. We haven't made a dent in it. You know, their estimates is it's going to cost tens of trillions of dollars every year to reach net zero. So again, this is not the solution for a real problem, which is the broken insurance market. I have enough Wisconsin residents live on the Gulf Coast in Florida to know after Hurricane Ian, we've got some real problems in Florida. But fixing climate change isn't the solution. So there are other causes, and that's what I really want to focus on with you, Dr. Anatoni. You talked about inflation. You talked about riots and lawlessness. You talked about high cost of properties being located in these vulnerable areas. And then, Commissioner Moretti talked about the harmful regulations, price caps. So can you, off the top of your head, I don't know nobody's calculated this, but can you give me some sense of what percentage of the total problem is each one of those elements? I mean, how much of, let's say it's $100 billion worth of problem here. How much of that is due to inflation? How much to the lawlessness, the riots? How much to the high cost of properties? And then how much has been just from market distortions of pricing caps and that type of thing?
Senator, it's a very good question. The only caveat I want to say in answering this is that much of the regulatory costs actually get rolled into what we attribute to inflation. The reason for that is because typically these regulatory costs, because it's something being done by government mandate, those are essentially assumed away under a hedonic adjustment. So if we can just talk about government action broadly and include both a failure to respond to criminal activity and inflation and regulatory costs, that explains 90% approximately of the increase that we have seen in insurance premiums over the last several years.
But I want to zero more. What do you think inflation is that component? I mean, just straight inflation. I mean, again, I know it's government action, but that government action, what percent is inflation? Is it half? Is it a quarter?
Probably about three-quarters, almost three-quarters, Senator.
Mr.
Senator
Moretti,
Johnson,
do you confirm that, or?
I just have a personal and timely example on the impact of inflation. About 6 months ago, we had our roof replaced in Tulsa, Oklahoma. And 18 months prior, I had a proposal to have the roof replaced. And in that 18 months, almost to the day, 18 months, same roofer, same roof, same materials, that cost had increased exactly 30%, from $20,000 to $26,000 for a roof that strictly impact on material and labors.
Okay, so that's
One
overall.
roof.
I mean, Florida is a just different animal here, right? I mean, Florida's insurance market is completely screwed up because of hurricanes, because of probably regulation, that type of thing. I mean, insurance conceptually is pretty simple. We all pay a little bit in to protect ourselves against a catastrophic loss, and with the marketplace, it moves around. If it's priced properly, it discourages people from putting high-cost properties in a very vulnerable area. But it hasn't been priced properly, right? So I guess I'm kind of wondering, for a Wisconsin resident with a Wisconsin house, how much are our insurance premiums being boosted because of the distortions of the marketplace, because of overregulation? Now, in other words, are we paying the price for all these hurricanes in Florida because the Florida insurance market is just screwed up? You have reinsurance companies that are losing money. And by the way, you did talk about high losses. What is that? I mean, how big a loss was this last year? And is that just lost premium versus payments, or did this go into reserves? Because isn't that the whole point? You get premiums, you set up reserves, you have a loss. Generally, the reserves ought to cover the loss, right? You shouldn't be taking them out of premiums. Premiums ought to just be continue to fill up those reserves. Mr. Moretti.
Yes, thank you. And I hate to oversimplify it, but sometimes I do when speaking publicly back in my state, and that is that, it's not rocket science, it's math. It is premiums in and claims paid out. And then what's the end result? Of course, there's investments, other things in there. I'm oversimplifying it. But it is math, and so the insurance companies have the role of determining what that math's going to be. What do those storms look like? I mean, in Oklahoma, we get hit. We have had a terrible spring. We have had 100 tornadoes this year, but the previous 4 years, we were substantially below our average. So we've had a rough year. We've had 2 EF2s. So the companies will absorb that. Our role is to make sure they're financially solvent, they have risk-based capital that we monitor quarterly, and if they're investing in things that they shouldn't be investing in, or we have concerns, heck, if a company drops a certain percentage of their surplus, they get a letter from me saying, what's your plan? You've dropped a bit here, a little too much in this past year, and so that's what we're monitoring to make sure they can be there to pay their claims. And like I said, we've had one company leave, we've had no property and casualty companies exit the market. But you've got to have that freedom and flexibility to price properly.
One quick comment, closing comment, is this hearing ought to be called Riskier Business, How Massive Deficit Spending, which caused inflation, is challenging the insurance markets. Would you kind of agree with that, Mr. Antoni?
I could not agree more, Senator.
Thank you.
Senator Merkley.
Thank you, Mr. Chair, and thank you all for bringing your expertise to bear. And the conversation is essentially focused on the challenge of flooding, hurricanes, so on and so forth. But let's go west for a moment. Let's go to New Mexico and California and Oregon and Washington, Idaho, Montana, Colorado, where wildfires are the real challenge. And we have a much longer, hotter fire season. We have more lightning strikes. As the climate has changed, the result has been much more devastating wildfires. So we are seeing folks go, our insurance rates are really going up, or I can't get insurance at all. I just held a group of town halls, 9 town halls in Eastern Oregon, and at town hall after town hall, people came forward to say, hey, I came to say I got a problem. My insurance company either has greatly raised the rate or has said they're not insuring anymore. What am I going to do? Well, so Dr. Sen, has any of your work focused on the challenge of the Western insurance markets and the growing destruction from climate change-induced wildfires?
Yes, I mean, I do look at the homeowners insurance market more broadly as well, not just the Florida experience.
And so you're aware of this growing challenge, and here's the rub, which is if your company says they won't insure you, then you have a mortgage, and the mortgage company requires that you have insurance. And if you can't find a private insurer, they will put an insurance policy on your property, and the mortgage company actually gets a kickback on these arrangements. So they have an incentive to go to a very high-priced policy, and that may be totally unaffordable to any ordinary family. So if you were at one of my town halls, and a citizen was saying, I've got this problem because if I can't find an insurance company, I'm going to lose my house because I won't meet the terms of the mortgage. What would be the right policy response to that challenge?
Right. What you're describing is something that we obviously are already seeing. Homeowners get force-placed insurance. They have to go to insurers of last resort. And in all these situations, they're basically paying a lot of money for the coverage that they're getting. Ultimately, what the solution is something that is obviously the main question that we are here to answer. But I would say that it is extremely hard to really figure out what the solution is, in part because we are not in a position right now to even answer some basic facts about how big the problem is, what exactly the numbers look like. For instance, we do not know basic facts about how much coverage people have in different places, how much they're paying. And when I say we don't know this at a granular enough level because the data does not exist. And the first step towards sort of designing any policy would for us to know exactly how bad the problem is, and then we sort of come up with a solution for that and start to evaluate these different policy responses. Right now, we're sort of trying to make policy blindfolded.
So in looking at the materials, I saw that Citizens Property Insurance Company, I gather that's Louisiana and Florida, that have a completely state-backed program. Well, all right, so if the state becomes the insurer of last resort, and they now suffer the same losses that a regular private insurance company is suffering. Now the folks in the state are carrying massive debt. So that doesn't seem like a great solution.
That's definitely a problem, right? I mean, the problem is, of course, that whether the state then has the fiscal capacity to actually withstand a big loss, like a big hurricane season, which is a concern that was raised about citizens. And in such a scenario, then in a world where they do not have enough tax revenue, then they would have to sort of go into financial markets, try to borrow money, which could be very costly and so on. So fiscally, it's going to be very challenging for many cities and many municipalities and counties and so on, yes.
Well, let me close with this question, and perhaps Mr. Musolin, I'll direct this to you. Is it responsible for Congress to say, we're going to ignore the enormous damage that climate change is doing across our country through fires, through smoke, through ice storms, through flash floods, through hurricanes, and we'll just somehow back up the insurance market? If we are looking ahead 20 or 30 years, shouldn't we be undertaking the core challenge of the overheating of this planet from carbon dioxide and methane?
Well, Senator, one thing, I would never want to comment on what Congress should or shouldn't be doing. That's certainly not my job. But I certainly think that we, in many cases, look decades into the future, as we do with, say, the Social Security trust funds or many other things. And this is an issue which has the potential to cause, significant losses to our economy and our system. And I think it would be responsible for everyone to start stress testing the system, to consider the possibilities. It doesn't have to be a certainty. We don't know the future for certain, but the possible exposure to damage up and down the East Coast and what that could mean for
And the
citizens
West Coast.
And I'm sorry, sir. I was referring to East Coast because I was stuck in Florida. But yes, the West Coast and across the country, sir. I should note. Apologies. But yes, we should be considering that, and including wildfires. And certainly we've even seen issues like the tragic fires in Maui, where things like the electrical grid can contribute to fires, and maybe we can kill two birds with one stone by hardening the grid against weather and also building it out for renewable power. So there's a lot of opportunities for us to do both.
See, my colleague, Senator Romney, is here, and my time's out, but I really appreciate your all's contribution, and I'll just say, from my perspective, it's hugely irresponsible for us to just say we can try to fix the insurance market and fail to address the underlying causes that will get worse with every succeeding decade far into the future.
Senator Romney.
My colleague, Mr. Merkley, I wish there was something we could do that would reduce the climate change we're seeing and the warming of the planet. But I've seen absolutely nothing proposed by anyone that reduces CO2 emissions, methane gases, and the heating of the planet. Climate change is going to happen because of the development in China and Indonesia and Brazil. And the only thing that actually makes any measurable impact at all is putting a price on carbon. And no one seems to be willing to consider doing that. Everything else that's being talked about in the climate
two
front.
bills.
I know, you and I are. But you guys had reconciliation. You could have done it all by yourselves, and you didn't. So the idea that somehow we're going to fix climate and solve the insurance problem is pie in the sky. That's avoiding the reality that we can't fix climate because it's a global issue, not an American issue. Anyway, let me turn back to insurance. I'm not going to count that as part of my time. Let's see. I'm going to ask you, ladies and gentlemen, about what we ought to do to try and help people be able to afford insurance. And I listen to the causes, inflation being the largest single one. And of course, seniors are on fixed income, so inflation is a huge problem, as Ms. Wood has indicated. Building in high-risk areas is a big part of the problem. And then there's climate. We're not going to be able to fix global climate, not in any time I'm aware of. And according to Mr. Antonini, so far, at least with regards to hurricanes and so forth, there's no evidence that climate is causing more hurricanes, although I think it's fair in the American West, where I come from, more fires, drought is climate related, and so that's just a reality. So the question is, what actions can we take? Fiscal reform, yes, to try and deal with inflation, except I want to note something, for Mr. Antoni, because you're esteemed at the Heritage Foundation. 72% of federal spending is not part of the budget we vote on. So we talk about Biden wants to spend all this, 72% we don't vote on. We only vote on 28%. Half of that is the military. We Republicans want more military spending, not less. So that means the other 14%, which is the Democrats want to expand, there's no way we can reduce the 14% enough to have any impact on the massive deficits we're seeing. So there's going to have to be a broader analysis of what we have to do to rein in our fiscal challenges. I want to underscore that. I would say a second thing we can do besides fiscal reform and dealing with inflation is stopping subsidizing high-risk areas. Basically subsidizing people to build expensive places along the coast and in places that are at risk of wildfire. And we subsidize that, and that creates huge financial risk to the system. And finally, mitigation of one kind or another. That's the other thing we can do is all sorts of mitigation. Forestry management, having people move in places that are not high risk. But if you want to live in a big house on the coast, you're going to have to spend a lot of money to insure it or take huge risk. That's just the reality. So those are the three I come up with: stop the subsidy, mitigation, and fiscal reform. What else am I missing? Mr. Muslin, and I'm just going to go down the line for those that are sort of in this area to give me your perspectives.
Well, thank you, Senator, and I'd agree with all those things, and I'd also add that we need to start thinking about future-proofing our building codes and land use policies. The sea levels are rising. There's, if you're going to build a house that's supposed to last 75 years, you ought to be thinking about the climate in 75 years when you give somebody a permit to build there. So I'd say that's important. I'd also say that, large disasters also drive inflation because it puts more pressure and demand on labor and materials. More disasters mean supplies that could have been used to build new homes for Americans are diverted to rebuild homes in the past. So certainly doing things to reduce the vulnerability of properties and improve their resilience is important. And I do think, sir, that there are things we can do about climate change with respect over periods of decades that can make a difference in the long run. Thank you.
Thank you. Yes. Sen?
Sure. So before that, one point about inflation that we are missing, which is, without doubt, it is a contributing factor. But the U.S. has had inflation in the past without such an acute crisis in insurance markets. So whether that is the biggest cause or not is up for debate. I don't think we have reached a conclusion on inflation being the biggest contributor of rising insurance costs.
It's just a big one. You'd agree it's a big one.
I agree it's a big one, but I wouldn't say it's the biggest one. In terms of policy solutions, I completely agree with you on we need to stop subsidizing building in high-risk areas. That's definitely one of the things that is definitely we need to do that. Mitigation, another point that you bring up, and on that I would say not only do we need to harden our homes, but we also need to harden our financial institutions, our banks, and our insurance companies in order to make them withstand really large climate shocks that are for sure coming their way.
Thank you. Ms. Wood, I'm going to let you pass on this just because that's not your area of expertise. Your experience was something which focused our thinking today. Mr. Mulready?
Thank you, Senator. I would say amen to your comments, but I'll give you three quick things. Number one, FEMA has a survey out that states that every $1 spent in mitigation saves $6 in lost claims. It pays off. Number two, unfortunately, a lot of communities have to have a disaster happen. In Moore, Oklahoma, back a dozen years ago, EF5 hit. It was just totally devastating. After that, the city of Moore changed their zoning. They changed their building zoning codes. And then third, the city of Tulsa, back in the 80s, had horrible flooding happened. And so they invested over decades, infrastructure to prevent flooding. Now we're one of only 2 communities in the country that are Class 1 NFIP rated.
Yeah, thank you. Mr. Antoni?
Senator, regarding the wildfires out west, I think California is a really good example of this. They have a deadly combination of terrible forest management, where they prohibit things like controlled burns to get rid of underbrush, and then also not investing enough in public utility infrastructure so that they have power lines that are throwing sparks, for example, and starting these wildfires. Regarding your comments on the budget, you're absolutely right. At this point, non-discretionary spending and gross interest on the debt exceed tax revenue. And tax revenue as a percentage of the economy right now is near an all-time high. So you're not going to actually get much more in terms of revenue out of this economy. And so that leaves you with essentially two options, both of which you should do. The first is the economy needs to grow a heck of a lot faster than it is right now. And then the other thing is that you need to address even non-discretionary parts of the budget.
Thanks, Senator Romney. Senator Van Hollen.
Thank you, Mr. Chairman. Thank all of you for your testimony today. You know, there are a lot of folks out there who still deny that climate change is real and the impacts and the human component. I've always believed that when skeptics began to feel the impact in their pocketbooks, it would become more real. And that is unfortunately what we are seeing. And today's hearing is an example when homeowners find that either they cannot get homeowners insurance or it becomes so expensive they can't afford it. Then we're seeing the real pocketbook impacts. And Ms. Wood, thank you for your testimony. I listened in via C-SPAN, and I think that really brings things home to what more and more Americans will be experiencing. You know, Swiss Re has done a number of studies on this, and yes, of course, there are a number of components to increasing insurance premiums. No one denies that there aren't different pieces. But according to Swiss Re, climate impacts and the growing risks from climate is the predominant factor in what they predict will be increasing costs due to climate risks. And I do know in my state of Maryland that in areas that are particularly vulnerable, we've seen property insurance rates going up in the Ocean City area and others. One way to address this, and I think it was discussed in a different matter, is the need to get the data and to get consensus on where the risks lie, which is why last year, Senator Whitehouse, Senator Warren, and I sent a letter to the Treasury Department, to the Federal Insurance Office, urging them to collect information from different states. I'm a supporter of a state-based insurance system for property and casualty insurance, but I do think it would benefit all of us to have a sort of national yardstick against which we can measure what's happening. So Dr. Sen, could you talk a little bit about the benefit of having a common source of insurance data through the FIO and how that could benefit state regulators and benefit all of us?
Yeah, absolutely. Thanks for bringing that up. That's just the first order importance, I think, because we don't even know the basic facts about this problem at a granular enough level. The risks here are local, and so we need to know what's going on zip code by zip code, census tract by census tract. And for regulators to be able to figure out exactly how much risk is sitting with each of these insurance companies, they need to know how much policies they're writing, what's the type of coverage they're selling, in what are the cancellations looking like in different zip codes. Only then can they figure out exactly how exposed these different insurers are, and then they can start designing policy about whether the risk-based capital ratios look all right or not, or should we put a surcharge on wildfires or hurricanes and so on. And we do need a comprehensive picture. We just can't have a particular state regulator look at the risks in that state because, of course, the insurer is selling insurance all over the country, and we need to get a comprehensive picture of all of that.
No, I appreciate that. I gather that the Treasury Department's getting some resistance from some state insurance regulators. I hope we can overcome that because I'm not sure why anyone would want to deny, the American people the benefit of the facts here. If I could ask you, Mr. Muslin, with respect to some of the sort of measures we should be taking. I mean, obviously we want to collect the information here in the Budget Committee, but what kind of measures should we be taking now to address and mitigate some of these issues, and what are the consequences of failing to do so?
Well, as I said, I think the biggest thing we need to do is future-proofing our building code and land use policies, as I said before. You know, we have to recognize that we're going to be facing extreme weather in places that we haven't experienced it before, and we've got to certainly address that. I also think it's important to address climate change. I will just note that sometimes climate change itself can contribute to the inflation we've been talking about. For example, there were beetle infestations and droughts and fires in Canada, which decimated some of the lumber crop and led to a forest and led to a 5-fold increase in the cost of lumber a few years ago. So some of this, you know, claims inflation is actually related to climate change, and I think we need to address that. And we also need to recognize that we have to build smarter and protect our people better to make sure that, you know, they've got affordable insurance and that they can fix up their houses when there's a disaster.
Appreciate that. Mr. Mulready, I saw you wanted to comment on that first question.
Thank you, Senator. I just wanted to follow up on your comment about FIO and the collection of data. If you didn't know, the NEIC, National Association of Insurance Commissioners, is in the midst of a data collection right now that will collect that data for at least 80% of the homeowners market. And we have an agreement with FIO to be sharing that data with them. They originally came to us. I got a letter from FIO, and they were requesting data that we did not actually collect at the zip code level. And they had a very stringent timeline for that. So my response, well, it wasn't no, it was just, look, we can't meet that timeline. We don't collect that today. We can in the future. But from that is where this has grown, the data called by the NEIC.
So I saw that there had been now this effort on behalf of the state. So is this now been worked out? Are there any states that are objecting to your knowledge at this point in time in terms of sharing data?
I don't know about specific states. We will be collecting data that will represent at least 80% of the market share.
Okay, thank you. Thank you.
Thank you for that, by the way. We're watching the data call, and we're grateful to the NEIC for that effort. Senator Kane had another question or two.
Just a follow-up comment, and it's really on that point. I think we often assume that rates charged homeowners by homeowners insurance is based upon some rational algorithm using actuarial data, but that is not always true. My legal career, the highlight of it was a lawsuit that I brought against the nationwide insurance company for redlining minority neighborhoods all over the United States in 1998. Led to the largest civil rights jury verdict in the history of the United States at that time. And we were able to gather data that, through the discovery process, that our insurance regulators didn't have, other states' insurance regulators didn't have, and it demonstrated that part of the entire set of where we put agents, where we sell policies, how we price policies was based on the racial composition of neighborhoods using zip code +4 data that essentially labeled every neighborhood in the United States in categories that were either we want to do business here or we don't. And so the notion that this is all, you know, actuarial and math and it's based upon claims experience and investment income, those are factors. But until you get the data, you can't be confident that there are not other factors at work that, you know, might explain why, you know, Ms. Wood, this whole thing about not even being told that your policy was being canceled and being told your roof flunked, but they're not going to give you the information about your roof, and the next company that analyzes it says your roof is just fine. You really can't assume that the system is being fairly operated in accord with actuarial data until you get the data. And I applaud the NEIC's effort, and Dr. Zen, your testimony and your answers to questions, you say we need to know a lot more to understand what's going on. I do believe these increases in places like Florida, coastal communities in Virginia, extreme weather events are playing a role, but there may be other factors that we need to dig into deeper if we're going to try to find the right relief so that homeowners like Ms. Wood and others don't face the kind of problems they're experiencing. Thank you.
Thanks very much. I appreciate the conversation we've had here. I appreciate all of the witnesses. I would like to ask 2 questions for the record, which will give you a chance to deliberate a minute and put your thoughts in writing. The first is for Dr. Sen. Here's your statement. Our analysis shows that a vast majority of the demotech insurers would not meet GSE eligibility if subjected to traditional rating agencies' methodologies. Would you be willing to elaborate on that in a paragraph or two so that I can better understand specifically what the methodological differences are that you're referring to and why they're allowed to exist?
Absolutely.
Thank you, I appreciate that. And Mr. Musulin, to your statement, the risks that threaten the U.S. coastal home insurance industry are potentially devastating. Could you elaborate on what the elements are of that risk, or of those risks? You used the plural. Specifically, including what role you think inflation plays,
Yep.
and elaborating a bit further on what you mean by potentially devastating. You are an actuary, are you not?
Yes, sir, I am.
Yeah, actuaries are not known for hyperbole.
No, but one of the lessons we need to learn, though, sir, is the difference between potentially the correct answer and the right answer. And often those two are somewhat different, and I'll strive to give you a mixture of both.
Yeah. I'm not challenging your testimony here. I'm just asking for further elaboration
I understand
on the
that.
point.
And I take it
What
on
do you
this-
mean by devastating? Who gets devastated? How? Elaborate on that. And what are these risks? And specifically, what role does inflation play? Because we are, watching this very carefully, and we're seeing people who are truly expert in the insurance market, including major insurers themselves, very clearly say that the problem here is climate change and the uncertainty of weather events and harms that they're not able to anticipate or predict for. So we've obviously heard other views here from entities that are funded by the fossil fuel industry, and it would just be helpful to know what your views are more specifically to that.
Yes, sir, and I'll be happy to say, if I might, just one quick comment that, regardless of whether we think we know what the future holds or not, it's a well-established practice in economics that uncertainty has a positive cost.
Yeah.
And the more uncertain we are about things, the higher the cost is. And I
Yeah.
think that's a significant factor here at play, too, and I'll make sure I
That and
include that in my comment.
6-inch hailstones, too. We may be setting new records.
Mr.
Thanks
Chair,
very much.
Mr. Chair.
Yeah.
One other thing, my innate sense of fairness makes me add an addendum to the comment that I last made about insurance rates not being purely actuarial in nature. I talked about the suit against Nationwide. After we successfully sued them, they dropped all the use of the non-actuarial data. They endeavored to do better, and years later they said, you know what, we actually not only did good, but by doing good, we did well, because minority neighborhoods turned out to be really good places to sell insurance, and the homeowners to whom we sold insurance turned out to be really loyal customers. So I didn't want to leave it hanging in midair with just the lawsuit against Nationwide. I also wanted to indicate that when we got information and put it out there, they took corrective action, and the corrective action ended up, working out well for all concerned.
Senator Lujan has appeared with seconds before the gavel, so let me respect his arrival by allowing him to ask his questions. I will just allow him a minute to get himself settled in his seat here, and thank him for attending. I want to thank all of you for attending. I think the personal experience of Ms. Wood was really important because, behind the statistics and the warnings and the threats and the risks and the potentially devastating consequences that are described by our expert witnesses are individual homeowners who are often swept around in the maelstrom of this insurance mess, not knowing where to turn, being shuffled around among insurance companies, not getting straight answers. And it is a hell of a tough time to be a consumer, and I want to thank you for putting such a good human face on that part of this problem. Senator Lujan, our closing questions.
Mr. Chairman, thank you so very much for this hearing. Thank you all for being here today. as well. I very much appreciate that. Now, 2 years ago, we had the most destructive fire in our state's history in New Mexico. The Hermit's Peak Calf Canyon fire tore through my state. This year, southeastern New Mexico is currently the only region in the nation experiencing exceptional drought, according to the U.S. Drought Monitor. And the National Interagency Fire Center reports above normal wildfire potential in wide swaths of New Mexico for most of the summer. I think everyone's that's been watching the news has seen the heat that's going to hit the Southwest over the next few days. Now, the potential for another massive wildfire is real. These climate-driven extreme weather conditions are changing the way New Mexican businesses operate. Electric co-ops are just one example. Co-ops are struggling to obtain wildfire insurance because of the chance their equipment is faulted for a major fire, because their lines have to connect communities. And in places like where I live, the shortest path and the path where they're located is often in some of these areas where there's a lot of trees and higher elevations as well. While co-ops and utilities are dealing with frequent extreme weather, they're also hard at work at the daunting task of clearing some of these easements as well, because it doesn't take much when it gets dry for something to tip over. And once that happens and it clips one of those lines, then we lose everything. In the Hermit's Peak Calf Canyon fire region, the bipartisan infrastructure law is providing money to the local co-op through the Grid Resilience and Innovation Partnership Program. The co-op will deploy modern grid technologies that both mitigate wildfire risk and help recover from power outages. Now, Mr. Mussolin, is that correct?
Close enough, sir.
Mussolin?
Muslin, but that's fine, sir.
Thank you. What can Congress do to support the rural co-ops and other critical infrastructure adapting to climate?
Well, thank you for that question, and I think there's no doubt that there's enormous opportunities in rural infrastructure and power grids to do both hardening those grids to to prevent tragedies like the fires we've seen, and also to support growth in rural communities, and to prepare the grid for the increase in renewable power, which is inevitably going to occur in the next several decades. So we can actually spend the same dollar multiple times and accomplish multiple benefits by investing in grid hardening and also, a more renewables-friendly grid at the same time.
I appreciate that. Now, when major wildfire strikes, it destroys both homes and critical infrastructure. If these basic services aren't quickly rebuilt, homeowners may be forced to leave their communities. And in a small town, in a small community, even a few people leaving completely erodes the tax base. It erodes the small business that may be in that community that everyone depends on. An eroded tax base undermines public services like emergency response and schools. This can decimate a town. Dr. Sen, if folks who want to rebuild can't get insurance, will these communities struggle to thrive?
Yeah, absolutely. Insurance is sort of required if you want to maintain a mortgage. And so in the absence of finding insurance, folks would have to either be forced placed by lenders, or they would have to resort to insurers of last resort, so the residual markets. And in all of these cases, the costs for the coverage that is being sold is extremely high. And so there is an immediate financial implication for the household exactly when they're also going through the devastation of having their home destroyed. On top of that, the other challenge is to not have enough insurance going forward for future shocks. And if you do not have adequate coverage for all of the future shocks that might be coming, then it makes you all that much more vulnerable for the next fire.
I appreciate that. Now, the Hermit's Peak Calf Canyon fire was a prescribed burn that got out of control. It was started by the federal government. Now, because of this, the federal government has a responsibility to the people of New Mexico to clean up and rebuild our communities. Disaster costs keep rising.
or as disaster costs keep rising. FEMA's reporting that its disaster fund could run out this summer and require additional congressional appropriations. Yes or no, are rebuilding efforts at FEMA strained by the cost of disasters around the country? Raid?
Yes, to the extent that FEMA has finite resources, more disasters mean more stress on FEMA. But I'm not really able to comment on what this may mean for the fiscal situation under the budget because I'm not familiar with that.
I appreciate that. And Mr. Chairman, when I sat on the Public Regulation Commission in New Mexico, it was a hodgepodge of agencies. We were essentially the Public Utility Commission. But New Mexico had insurance underneath it. The superintendent of insurance worked for the commission. We had oversight over them. I just certainly hope that through our experiences throughout the decades and even now as we're seeing what's happening in this particular space, that we have folks that are willing to police themselves, that if a company's not a good company, that some rogue commissioner doesn't try to relocate them into a jurisdiction that may allow them to get licensed there, and then that company preys on other company or other families and things of that nature, which only compounds the problem we have today. That was happening when I was elected to that particular body, and it's just not right. So with all the challenges that we have across the country, I certainly hope that there's a way for state by state to get this right. If not, Mr. Chairman, we all need to have a serious conversation about what's going to happen at the federal level to make sure that we're going to be doing some things in a different way for the good of all the people that we represent all across America. So thank you very much for the time, and thank you for letting me go over my time.
Thanks, Senator Lujan. Thank you to all of the witnesses. Mr. Muslin, sorry I said Musulin before, Muslin, if you don't mind me adding an edit to the QFR request to you, it would be also to elaborate a little bit on your description of the cycle between climate causing inflation and inflation itself. We've certainly heard a lot of testimony about that in the agriculture area here with respect to shipping delays in the Panama Canal and through a whole lot of other vectors. So I would appreciate that. Anybody else with questions for the record, they'll be due by noon tomorrow by email or with a signed hard copy delivered to the committee clerk. We would ask that QFRs be responded to within 7 days of receipt. And with that, the
Mr. Chairman?
hearing is adjourned.
Okay. If I could, just 1 minute on Senator Lujan's comments on FEMA, and at the risk of, as my mom would say, sounding like a broken record, I've met with FEMA numerous times this year in the state of Oklahoma with some of our disasters. FEMA Administrator Criswell came to Sulphur, and I toured that with her, and she did a wonderful job, by the way. But FEMA's own survey from a few years ago, again, shows a 6-to-1 return on dollars invested in mitigation. FEMA comes into our communities, they've been in numerous of them this spring, and they help out with the individual assistance and as well as SBA loans. Because some of that money was put towards mitigation. I think that would be extremely helpful. Thank you.
I think that's a good point to end on. Thanks very much, everyone. Hearing's adjourned.